relationship. But if you're a primary dealer, what it means is that you can act as a dealer to the Fed. When they want to buy or sell securities, they call you. There are only about 20 names on the list. It's not like 200 banks or whatever. I was on the executive committee of one of the primary dealers for over a decade. I talked to the Fed every day. At that time. But what it means is that when the open market desk at the Federal Reserve Bank in New York wants to buy or sell securities, they call your firm or one of these other firms. So what do? So when they want to print money, basically expand the money supply, and when we say money supply, we're talking about M0. I always point out there's M0, M1, M2. The Fed doesn't even know what money is because they've got vanilla, chocolate, and strawberry. They got 3 flavors, so they're not even quite sure. But what the Fed prints is M0, or so-called base money. So how do they do it? They call up Goldman Sachs or Morgan Stanley or Citi, and they say, offer me 5-year notes. And the trading desk at Goldman says, okay, here's our offer. Fed says, done. Shoot them in. So Goldman will deliver the 5-year notes to the Fed, and the Fed will pay for them with cash. And the cash does come out of thin air. That is money that the Fed just says, hey, here it is. But what does, in my example, what does Goldman Sachs do with the money? They give it back to the Fed in the form of excess deposits. Remember, the Fed is a bank at the end of the day. So when the Fed prints money, they buy securities. So they're increasing the asset side of the balance sheet, but the dealers are giving the money back to the Fed as a bank deposit at the Fed, and so they're increasing the liability side. So they're expanding the balance sheet, but that money is what we call sterilized. It doesn't actually go anywhere. That money does not get lent. It does not get spent. It doesn't drive the economy. The idea of the stimulus is nonsense. That's just not true. If somehow in an alternate world there were a shortage of reserves, maybe, but the fact that they're called excess reserves tells you all you need to know. There are trillions of excess reserves on deposit at the Fed. So does the Fed print M0? Yes, but it goes back to the Fed as excess reserves and doesn't do the economy any good. There's no stimulus. There's no inflation coming from it. It's an accounting exercise. Okay, where does the money come from that does drive the economy? That does not come from the Fed. It comes from commercial banks, because Citibank or JP Morgan or Bank of America can do the same thing as the Fed. And how do they do it? Well, I go in, I say, I want to take out a loan. And they say, okay, here's the loan agreement, you're approved, sign the promissory note, I give them the note, and they put the money in my account. Where does that money come from? It also comes out of thin air. In other words, the commercial banks can print money the same as the Fed by just debiting my bank account. But that money, that's M1, a different kind of money, different flavor, if you will. Now that money actually can drive the economy, because I sign the note, I get the loan, the money's in my account. Now I can hire people, I can invest in fixed assets, I can do development, I can do whatever I want with the money. But the point being that money printing counts. So Fed money printing is irrelevant. Stop. The Fed's almost irrelevant as an institution. They have the worst forecasting record. They get everything wrong in terms of their modeling, and their money doesn't count. So everyone likes to talk about it on CNBC or whatever, but you can almost skip the Fed. Commercial banks, no. Commercial banks, they create the money that actually drives the economy. Now, by the way, there's another source of money that does drive the economy. It's not monetary policy, it's fiscal policy. In other words, when the Congress says we're going to have a $1 trillion COVID stimulus package, or a $1 trillion Build Back Better, and Trump did $1 trillion in his first term, and then Biden and Pelosi did $2 trillion. It's like, I'll see your trillion and raise you $1 trillion of spending, deficit spending, over and above the baseline deficit. We had a baseline deficit of $1 trillion, and then Biden and Pelosi put $1 trillion on top of that in 2021, and then another $1 trillion in 2022. Remember the August 2022, the Inflation Reduction Act? All it did was it caused inflation. It didn't reduce anything. And it was really the Green New Scam in disguise. But the point is, when the government, the Congress, and the White House do that, and they push $1 trillion of spending, government spending, into an economy that's already overheating, that can cause inflation. It can be stimulus up to capacity, but once you exceed capacity, it's just pure inflation. So the Fed doesn't matter, but deficit spending does, and bank money creation does. So, and that bank money creation, as I say, is an M1. So that's the money to watch. If you're trying to figure things out. Now, to your point, Vladislav, you talked about velocity. Well, what is velocity? It's the turnover of money. Basically, it's GDP divided by the money supply, meaning how many dollars of GDP do you get for each dollar of money in the system? And again, we're talking about M1 or maybe M2. So let me give, not to get too geeky with the math, let me give a very simple example. So let's say the bank gives me $1 and I go, or, $100,000, whatever, and I go and I buy gold and I put it in a vault. That money has velocity of 0. It didn't do anything. I converted it into gold and I sit on it and I don't do anything. Let's say the bank gives me money and I go out and I hire somebody and I pay the person. And then that person goes out to a restaurant and buys dinner. And then on the way home from dinner, the waiter takes an Uber to get home. Well, that money has velocity of 3 because you got the wage, the dinner, and the Uber. And again, on and on and on. Obviously, it's more complicated than that. So the point is, if I just put the money in gold, I'm not against gold, by the way, I recommend having some gold, but just to be clear, but if I put it in gold or just sit on it, velocity is at or near 0. If I spend it or invest it and then the recipient spends it, invests it, et cetera, then that can have a multiplier of 2 or 3 or 4, or it can be quite high. So that's really what counts. Now, velocity has been declining for 26 years. It was around 10 or 11 in around 2000. Today, it's down to barely over 1. Is kind of, well, it's about 2 actually. But the point is, all the money printing in the world doesn't do any good unless the turnover is there. And this is what Milton Friedman missed. The quantity theory of money is, MV equals PQ, PY rather, where M is the money supply, V is the velocity, P is the price index, which can be inflation or deflation, and Y is real GDP. So real GDP times inflation is nominal GDP. So that's what the PY is. Money supply times velocity equals nominal GDP. So how much money is there? How much is it turning over? That equals nominal GDP. But each side of the equation has 2 parts. So Friedman said, well, mature industrialized economy like the United States can only grow about 3.5% in real terms. That's about right. I mean, you can debate it, but that's about right. The only time we grow more is coming out of a recession when you have unused capacity. So let's just say 3.5%. Friedman said we want P to be 1. If P is 1, that means no inflation, no deflation. P equals 1 equals price stability. In other words, nominal GDP equals real GDP. There's no inflation or deflation. Then he went over to the other side of the equation and he said V is constant. So we'll treat M like a thermostat. We can dial it up or dial it down. And if we dial it up, we'll try to get real GDP to 3.5% and then stop because we don't want inflation, or dial it down if the economy is getting too hot. Almost like you had a dashboard and you control things. What's wrong with that theory? Well, by the way, the equation is true. Irving Fisher, understood it, and Anna Schwartz and a few others understood it. Not very many people, by the way. What's wrong with Friedman's approach is that velocity is not constant. Now, it was from 1950 to 1980 during the main part of Friedman's career. It was pretty flat, pretty constant. So his assumption was not a bad pragmatic working assumption, but it's not true in theory. The truth is velocity can go way up or way down. So your thermostat idea completely falls down because you're controlling one variable, but you're not controlling the other variable. The problem with velocity is behavioral. It's not about money supply. It's not about so-called printing. It's not about fiscal policy or anything else. It's about psychology. And this is where inflation can run away. You can actually hold the money supply constant. Just say, hey, we're not going to print any more money. Make that constant.